seconds. Go ahead, Ingryd. Open us up.
All right. Well, welcome to the Explain It podcast. With us today, we have Devin Burr, who I'm so excited to have him on the podcast. I met him a couple years ago when we used to go to the same meetups. And at the time, I think he was probably doing more real estate investing than he is now, but he can correct me if I'm wrong. And I was just exploring the space of investing. I don't even think I had my first deal under contract yet when I met Devin, and just learning all the possibilities. Because once you real estate investing is like the gateway of other entrepreneurial contacts or opportunities. Sorry, I did not realize I came into a floor where a whole bunch of people are out here now. So Caroline, how's your week going? And Devin, thank you for your patience.
No worries.
Things are great. I'm actually just really excited for this. I was trying to make sure everybody knew that we were live on Instagram and on Discord. So if you guys are on here right now, if you would go tell a few people we're live, I'm a newbie to this. I've heard about you, Devin. I'm in Phoenix. Ingrid's explained you a few times to me. I have my questions ready to go. But we're excited to have you on here. Everybody, this is a free podcast we do. We want to give everybody more access to how to get wealthy and to retain your wealth. So Devin, my first question is going to be, who are you for everybody? And then we'll get into more and we'll take questions in the side chat.
Cool. Well, guys, thanks for having me. Ingryd, I remember us being at those meetups back when, and it's crazy to think you hadn't even done a deal yet. And now you're just crushing it. So much props to you for actually learning something, but then taking action. I think that's the biggest thing. A lot of people, they get into this, I wouldn't call it a rut, but they get in this space where they just want to learn, and then they don't do anything. So knowledge is only powerful if you use the knowledge, which you've done. So tip my cap to you, even though I'm not wearing one. Most people always see you with a hat on. So who am I? To answer your question, Caroline, I started off in real estate, October 8th of 2019. I left my job. I worked at Quicken Loans as a loan officer, and I just kind of went out on a whim. I'm like, I want to try this thing of real estate, see if I can do it. I started off wholesaling. I would go to meetups and just make relationships and try to JV deals with people. So I did some wholesale deals, started flipping houses with my mentor at the time, Templeton Walker. Shout out to Temp. Great friend of mine. He had done flips, and I just wanted to learn the game. So I started to JV deals with him, and we would just split the profit. Mm-hmm. Probably about 4 months in to doing things, I had done 8 or 9 deals. 0 marketing dollars, just going to meetups, meeting people, shaking hands. The more hands you shake, the more money you make. So I started doing that, and there was a time, I'll never forget this. Me and Temp are walking a property we're about to buy. And he tells me, he's like, dude, you've been crushing it, just kind of riding my wave, so to speak. You can create your own wave. I'm holding you back if you always do deals with me. Figure out what's unique about you and then lean into that. So I put some thought into it, and I knew about this method of investing, the Burr method, where you buy, renovate, rent, refinance, repeat. My last name is Burr. Burr. So I'm like, I am Mr. Burr. How about I become Mr. Burr, the guy that does the Burr method? So I just started really looking for those kind of properties. We put out a music video, spoof music video. It's the dumbest thing ever, but I got 4 or 5 deals from it, and just started really holding on to a lot of properties. We were up to 10 properties. The market in Phoenix went crazy. So just started selling them, took that equity and started getting into bigger deals, Airbnb properties. And then I learned about this thing called infinite banking, and everything exploded from there. So it's been almost 4 years since I left my job, and it's just been a crazy ride.
So I'm just curious, what were you making as a loan officer? What's the percentage would you say is different from what you're making as a loan officer to now?
So the first year that I got into investing, I made almost as much.
Mm-hmm.
So
And you were learning.
Yeah, I mean, it's crazy. So I wasn't crushing it. I think as a loan officer, my last year I made 117 grand in 2019. So nothing crazy, but when you work for someone else, you, especially as an employee, W-2 employee, you pay the most amount of taxes.
Mm-hmm.
So I made 117, but I paid a ton in taxes. I was maxing out my 401k. Worst thing you can do. So really, I didn't have much money after everything was said and done. My first year in real estate, 2020, I made about 160. So I actually made a little more, but I kept more of it because of all of the things with real estate, how you can keep more money because of write-offs and all that stuff, being a business owner.
Mm-hmm.
So made more money, kept more money. And then all that let me do is invest more because I don't spend a lot on dumb things. My wife is like super frugal. I'm not as much. We balance each other out.
Okay. All right. Well, Ingrid, I have my questions lined up for Devin, unless you want to ask anything. All right. Here we go. I get to ask the questions we started. All right. So let's start out with, what the heck is infinite banking?
Infinite banking is becoming the bank in your own life. If you think about, everybody has a banking function that they have in their life. Whether you're buying a car, generally speaking, you go get a loan from the bank. You're buying a house, you get a loan from the bank. You're using credit cards, that money is from the bank. And then every time you put money somewhere, where do you put it? You put it in the bank.
Mm-hmm.
So the business of banking is one of the most profitable businesses there is, because think about what banks do. They take our money on deposit and then they lend it back to us as the American
Mm-hmm.
people. So they're lending us money. Let's keep math easy. Let's say you put your money with a bank and they pay you 1%. No bank pays 1% on a regular checking account, but for easy math, let's say that's what they do. They pay you 1%, and let's say they lend that money at 5%. How much are they making? Most people think 4%, right? Right, 4%.
Yeah.
That's not correct. They're actually turning 1% into 5%. That's a 400% return. So the business of banking is extremely profitable. There's not a bank in the nation that makes less than 400 to 1,300% on our money. We put our money there, they take it and they go make huge returns with it. Mm-hmm. So infinite banking is just you taking that function back. You put your money into a place where you control what it does. It's a place that's guaranteed to grow tax-free. It's protected against lawsuits and judgments, so no one can take the money. It's with more stable places and institutions than banks. Where you put this money, these companies have been in business for over 100 years and profitable every single year. So we're talking about Great Depression, World War I, World War II, meltdown of 2008, swine flu, bird flu, COVID, you name it. Doesn't matter what's going on in the world. These companies are profitable. Mm-hmm. And what that means is you're a part owner in the company. So when you put the money there, it's a mutually owned company. When they're profitable, you're profitable. So it's guaranteed to grow, tax-free, protected against lawsuits and judgments, with the most stable companies in the nation. The companies are always profitable, so your money always grows even more than the guarantee. And then you can just use it to go buy things you were going to buy from a bank. If I go buy a car, I borrow from this pot of money that never stops growing to go buy the car. And if I would have bought the car from a bank, I'd have to pay the bank payments, have to pay them interest for borrowing my own money. Think about it. I place money in the bank, they lend it back out. I'm borrowing my own money. They're just charging me for it. So what I do, infinite banking, is you put your money in this safer place, this higher growing place, guaranteed to grow. Then you just borrow against it, go buy what you're going to buy, and pay yourself back what the bank would have charged you. You're just taking back the banking function in your life So you make the profits instead of the bank making the profits.
Ooh, okay. So say somebody, they watch this podcast and like, dang, I need to get into infinite banking. This sounds incredible. And they go, I mean, if we reach out to you, can you help us set up infinite banking for ourselves?
Yes. So I started off just being a practitioner. I started infinite banking using it all my real estate deals at the end of 2020. I learned it during the summer of 2020, and then I started implementing it. And my real estate deals, the profitability, because if you can become the bank on an investment, that investment just got more profitable. Think about it. Banking makes 400 to 1,300%. That's what banks make. If you can take that and now you make that on a real estate deal that's already making a 20% return, 50%, 100%, 200%, you're combining two things, your profitability just skyrockets. So I started seeing that and sharing it with people, mom, dad, brothers and sisters, friends. Everyone's looking at me like I'm crazy. But once I could show them proof, it started getting ridiculous. And then everyone asked me how to do it. So I figured, well, why don't I just set people up with it? So I started doing that in March of 21. And I've set up over 1,500 of these different accounts.
Okay, so I put your Instagram, like stop sharing this so everybody can see. His Instagram is right below his name under the green there, so you guys can find him on there. Can we just find you on Instagram and message you on there and talk about it?
Yes. So on Instagram, I have on my bio, there's a link and it takes you to my landing page. At the top, it says Infinite Banking. If you click on that, I have a free training on the entire concept. Okay. And it'll give you like, perfect. Yeah. So if you just click on that link, takes you to my landing page, click on Infinite Banking, gives you a training. You just have to watch the training. And at the end, you can actually schedule a call with someone on my team. And everyone on my team, they've used the concept. They know how to, they're practitioners themselves. They know how to explain it. And really, that's all we do. We don't sell anything. We just explain the concept. Once you really understand it, there's no selling involved. You're going to want to do it, and our team can help set it up.
Okay.
We love that explain it perspective, especially here on the Explain It podcast.
Pun intended.
So my next question is going to be, Devin, I come over here, I click on the link on your Instagram, I go through and I watch the video, and I have some money I want to put in there because I want to go get a car. How long will it take for me to be able to borrow against this to go buy something with that money that I've invested?
Great question. So if first time you put money in, it takes a little bit longer because your money has to clear from your bank into your infinite banking policy. So your bank might take a week to clear. Let's just say that's usually about how much long it takes, like 7 days. So it clears from your bank, comes over to your infinite banking policy. From there, you have to request whatever you want. So let's say the car is 50 grand.
Okay.
You request that amount, and then that money comes back to your bank of choice, usually within a couple business days. So the longest I've really seen when you first do it, it's about 2 weeks, maybe 3. But once that first money comes over, I mean, it's just a couple days every time you want to use money.
And I want to say that for me, it was that same experience. Like once we decided we were ready to loan against my own policy, it didn't take very long. I will say the biggest problem is that I'm married. And so you have to do extra paperwork to say that you are allowed to clear that money. And also I didn't pay attention that I should have had the money completely, like all my documentation that said wire me versus send me a check. So I had a check sent. So that was a little bit slower. I mean, but I'm talking about like days, not months, right? Yeah. So it's just something to think when you're filling out the paperwork that you're ready to loan against your policy, like, or borrow against your policy. That's literally the tactics. So Devin, I'm seeing in the commentary that people are asking, are these IULs? What does it mean? People get so confused with term life insurance, whole life insurance. Can you clarify that a little?
Yeah, great question. So one thing just to piggyback on what you said, Ingrid, is the only reason you have to do that is because we live in a community property state, Arizona. So not every state has to do that, but just community property you do. But as far as the policies go, there's two types of insurance policies. And in case you guys don't know yet what I'm talking about life insurance. But life insurance is not called death insurance, right? Most people just think it's a death benefit.
Mm-hmm.
It's called life insurance. If it's used correctly, you should be able to use it while you're alive, not just for your family to get a death benefit. So that's the first thing. Two types of policies. There's a term policy, which covers you for a certain term, 5-year, 10-year, 20-year. It's basically renting insurance. If you are to die during that term, your family gets a death benefit. That's the only benefit. You're just renting the insurance. That is the most common because that's the most profitable for the insurance company. I mean, think about this. I'm 38. If I got a 20-year policy right now, it would expire at 58. The likelihood I'm going to die as a healthy individual, not a crazy lifestyle, me dying by 58 is very, very slim. Insurance company knows that. So they're going to get all those payments for 20 years. I'm going to outlive the coverage. And then for me to get that exact same coverage at 58, it's going to be way more expensive because now I'm more likely to die in the next 20 years. So term insurance is the least expensive when you're young and the most advertised because it only pays out 1% of the time. That means 99% of the time, the insurance company won the bet. They bet you were going to outlive the term. You're betting you're going to die during the term. Crazy bet. Why would you take that? That's one type. Second type is permanent insurance. That covers you your entire life. Doesn't matter when you die, when it happens, not if, when everyone passes away, you're going to get a death benefit for your family. Doesn't matter when it is. There's permanent whole life, and then there's universal life. Universal life is something that I feel should be used for like retirement planning and that kind of thing. It should not be used for infinite banking. Anyone telling you otherwise is chasing a paycheck. I can promise you that. IULs, super high commissions, ridiculously high. And whole life can have very high commissions as well if it's built for the death benefit. What we do, we lower the death benefit, so lower commissions, lower cost, and we have you overfund it. That's what's getting you all the cash value. All that overfunding, I don't get paid commissions on. It's getting you extra insurance. There's no cost to it. So you're getting your cake and you're getting to eat it too. That money is all protected against, like I said before, lawsuits, judgments. It's guaranteed to grow. There's just no commissions. So if an agent knows how to structure it, most of them don't. They don't want to because they want to make more commission. So
that's the only way we should ever say that phrase, by the way. I hate when people say they're having their cake and eating it too. And I'm like, why else would you get a piece of cake? So thank you, Devin. But I love this. So what you're saying is that if you have the right partner in these policy creations, you have to be very clear that they are structuring them correctly. And I believe if people click on your link, that's exactly how your company or your group was created, correct? Because one of the things that you were trying to avoid is not taking advantage of people, basically, like making sure that you're doing it with the right intention in mind.
Right. I only set up policies like the ones I have personally. And I first started my first policy at 34. At 34, I'm thinking, I don't need life insurance. I'm not going to die anytime soon. God willing, knock on wood, right? So my need for life insurance isn't high. My need for capital while I'm alive, that is what I care about. And that's what these policies are built for. They're, again, the main thing is we lower the death benefit. So you're de-emphasizing the death benefit and you're overemphasizing the cash value. The cash value is what is important to be able to borrow against to become the bank. So I just looked at it like that. I don't really need life insurance right now. However, if I put a bunch of money in these policies, I'm going to inevitably have a bunch of life insurance. So if I were to pass away, God forbid today, my family, as of right now, is going to get upwards of $40 million. I think they'll be okay, right? The craziest part about these policies is they're built in a way where the cash value always grows. As the cash value grows, the death benefit has to grow as well for it to stay a life insurance policy. So, and to stay tax-free. So as the cash value grows, death benefit grows. So when I'm likely to die, let's say I'm 80 years old, 90 years old, if I don't start any more policies, which I fully plan on, I've got 12 of them, I fully plan on starting much more. If I start 0 policies from here on out, instead of 40 million, the death benefit is close to 200 million. That's compound interest at its finest. So it's all about compounding your money early on, using it without interrupting that compound growth. That's the secret sauce of infinite banking.
How much? So I see a few other questions over here. Mundo said, what's the percentage limit you can pull out? And then Corey below said, it has to be a secured policy, right? Meaning if you have at least contributed 50K, if you want to withdraw 50K, is that correct?
Great question. So think of it like this, guys. As I said before, you're overfunding the death benefit. Regular whole life doesn't create cash value for a while because all that money, it's going to the commissions, it's going to the cost of that death benefit. So it takes several years for that amount of money to start gaining cash value. So what we're doing is we're lowering that amount so that portion, you don't have access to what you're putting in because it's going towards the death benefit, right? So easy math. Let's say you put in $10,000. Of that 10,000, you'd have about 2,500 to 3,000 to the death benefit. The rest is you overfunding. So that's what you have access to. You don't have access to dollar for dollar because there's a cost for that death benefit. But as time goes on, as the years go on, your cost never changes. That's the beauty of whole life. It's guaranteed 100% level. It never goes up. So if that cost is $2,500 per year, it'll never go up. So 3 years in, it's still only 2,500, but you've got growth of all these other years. So you have access to that overfunding. Let's call it $7,500 plus all the growth from those years. So generally speaking, by year 3 or 4, you put in 10 grand, you have access to more than 10 grand. And then the next year you put in 10 grand, you have access to even more because your money never stopped compounding and growing. Hopefully that makes sense.
That did. Could you mute your phone just because it's right by your microphone and we are all hearing that ring?
I'm on my laptop, so if I mute it, I know what I could do.
No, do not disturb. There we go.
Okay, well, Devin does that. I want to get, so I want to be very transparent with our audience, and I had a policy done with Devin. Okay. I actually searched high and low. Even though I met Devin at a meetup, I wanted to make sure that I was partnering with somebody I could trust and that they weren't just going to take me for my money, right? And so I'm a learn it all. I went and I read Be Your Own Bank, which is a great book. What Would the Rockefellers Do? Another great book, which had a lot of grammatical errors, but he must have self-published. All the stuff like that. And it was amazing. But I took out a policy that was, I think $60K or something like that, close to it. And I had over $50,000 that I had access to right away. So I just want to give you guys some context. I know he's using smaller numbers, which is great because I think this should be an everyday person's ability to do so. But every year I'm expecting to put my premium in, which is around 12 grand. And in our real estate investing world, that's 1 to 2 wholesale deals. Mm-hmm. So for me, it felt very comfortable to start at that range. And the way I keep thinking about this, I was like, man, when I took that $50K, I should have just started another policy. Is what I was thinking. I was like, is it called an infinite banking strategy, because you could technically just keep using your own money over and over to start new policies until, you just hit that threshold. But just to give you guys some context, like I'm an actual practitioner of this. I'm definitely not selling anything. I don't make any money for Devin, like getting any of this business, but it's legitimately like a process you can use. And that 60K, that policy that's sitting there, is growing at a guaranteed rate. I'm not, even though I took 50K out, that all that money is compounding, because it's not the actual money that I took out. I actually just loaned against it. Correct?
Yeah. So the 60 grand still compounding. Most of your viewers and listeners they're real estate people, right?
Mm-hmm.
So the easiest way to understand it is if you think about it like a house. A house is collateral to get a loan from the bank, right? So the bank will loan you money on the house, and the house is the collateral to get that loan. The more valuable the house is, the bigger the loan, right? So if you get a loan from the bank and the house is the collateral and you don't make your payment on the house, what can the bank do? They can take the collateral, right?
Mm-hmm.
So view it like that. Policies, the money you're putting in is the collateral to get a loan from the insurance company. And all you're getting is a advance of your future death benefit, because they know you're gonna die at some point. They just don't know when. So they'll gladly lend you that future death benefit, because if you don't pay it back, they'll take the collateral and pay your family less than that death benefit. So if your death benefit's $1 million, you borrow 100,000, you never pay it back, you kick the bucket, they're paying your family 900,000, not $1 million. So if you view it like that, think about your house. If you take an equity line and you use the entire equity line, you take all your equity out of the house, did your house value go down? No, the house value is still the same. Mm-hmm. It's the same thing with a policy. You use all your cash value, your value of that policy doesn't go down. It's still growing and compounding. So if a house is guaranteed to always go up in value, you'll always be able to borrow more money against the house. It's the same thing. It's just houses aren't guaranteed to go up in value. Markets can crash. Policies can't. Guaranteed by law in the contract, it'll never, ever, ever grow less than 3.25 tax-free.
Why isn't everybody doing this?
Oh, that is a can of worms. I think probably one of the biggest reasons is, like I talked about term earlier, mm-hmm. Everyone knows term insurance because that's what everyone hears. That's what's advertised. Mm-hmm. Of course, it's going to be advertised. It's the most profitable for the insurance company. So I think that's the first thing, is most people just think of term. The second reason I think is when people think of whole life, they think, oh, it's really expensive. It pays a ton of commissions. It's a horrible place to put money because you got to wait 10 years before you get cash value. All of that is true for regular whole life. As I said, this is not regular whole life. The agent has to know how to do it. And if they know how, they have to be willing, right? So if an agent somehow knows and has been trained on how to do it, and someone says, I want a policy built for infinite banking, that agent's going to be like, oh, my commissions are going to be 60 to 90% less. Why would they do it, right? So there's just not a lot of incentive. Mm-hmm. The cool thing is I got into it. I didn't need to make money on commissions. I was already making really good money in real estate, and this helped me make more. So I figured if I can just help people do it, I'm going to eventually make a lot of money in commissions because I'm going to help a lot of people. And then 1,500 policies later, I've made a lot of money in commissions, but it's not at the expense of the client getting what makes sense for them.
That makes sense. Okay. One other thing I want to ask before I get to Karina's question. So we're investors. We get a lot of deals. End of the year comes and we're like, oh my gosh, I made a lot of money. Can this help you offset your taxes?
Yes. In a big way. Okay. I'm not a CPA. I'm not advising just to cover my butt. I'm not telling you what to do. I'll just let you know what I do. Okay. Just as a disclaimer. So first things first, the policy grows 100% tax-free. It's a private contract between you and the insurance company. So you don't have to share that contract with anybody. So therefore, all the growth doesn't have to be reported. It's private. Life insurance predates the tax code. Tax code came around in 1913. Life insurance has been around since the 1700s. So it's way before the tax code.
Okay.
It stood the test of time. So that's the big thing. It's not going anywhere. That's the first thing. All grows tax-free. And you can do different strategies with your policy to lower your tax bill. Couple ways that I do. Again, I'm not advising you do this. I'm just saying what I do is I have a daughter. She is 16. From the age of 7, I believe, until 17, you can pay your kids around $13,000 a year. You don't have to pay taxes on it from your business, and they don't have to pay taxes on it as income. This is within the tax code. So I pay my daughter $13,000 a year. That lowers my tax bill on my business. She gets the money in a joint account. It's a custodial account. So I own that account. Her name's on it. From that account, I fund her policies. So think about this. The money is tax-free. I'm not getting taxed. She's not getting taxed. It grows tax-free. Eventually, my daughter is going to pass away. Hopefully, that is a long, long time from now. Mm-hmm. When she passes away, the beneficiary gets a tax-free death benefit. So that money I'm putting in, there's no taxes on the front end. There's no taxes on the growth. There's no taxes on the use. There's no taxes on the death benefit eventually. That's one way. I mean, gosh, there's a lot of different ways. So if you guys want to know a bunch of them, I can get into them.
But I mean, can I just say, like, you end up doing a lot of wholesale deals. You're bringing a lot of active income, and you need to offset like the tax bill that you're going to get for this year. Just buy a really big policy, and that can help you out really. Or should you buy multiple little policies? What would you recommend as a not CPA to kind of help us out?
I love how you threw the disclaimer in there, so I don't have to. I love that. So the size of the policy doesn't matter, because if you do 10 policies at 10 grand or one at 100 grand, it's the same money compounding. There's no difference. Okay. It's easier just from a logistic standpoint to have one policy to manage instead of 10. So, you know, aside from that, if someone's wholesaling, here's a great way you could use it. As a wholesaler, you've got different marketing, right? You've got cold calling, you've got
texting,
mailers. It all costs some money, right? So most wholesalers, they have a budget. They'll say, I'm going to spend 5 grand, 10 grand, 15, 20 grand on marketing, whatever it is. That money is going to come from where? Your bank account. Mm-hmm. If you use it from your bank account, that money is no longer growing inside your bank account, right? However, if you just simply take that money, put it into a policy first, now that money is going to grow, compound, tax-free, guaranteed for the rest of your life. So it goes there first, then you borrow against it, it goes back into your bank account, and then you do your marketing, right? Here's one other thing you should do though. That money goes to your personal bank account. The policy's on your life. So the money has to go into your bank account in your personal name. So what I do, once that money's in my personal bank account, I lend it to my business. So I create a note from Devin Burr to Mr. Burr LLC. That's all. I'm the bank, so I can create that promissory note. I create the terms. So the terms for me generally, interest only, 15% indefinite. So think about that. If I'm a wholesaler, if I've got a budget, the money goes into a policy first, it's guaranteed to grow. I borrow against it, it goes to my bank account, and I lend that money to my business in order to pay for the marketing. My business now has a business expense, 15% interest. So that 15% interest is coming from my business bank account as an expense to my personal to go back into my policy. So I'm getting more money in my policy and lowering my tax bill.
Infinite. Yeah. Oh my
and
God.
you can just keep doing it. So think about this. If let's use bigger numbers so it makes kind of more sense.
Okay.
100 grand. Let's say I borrow that from my policy and then I lend it to my business, interest only, indefinite at 15%. That would mean my business is flowing $15,000 a year. So 15,000 less on the taxable side. That 15 grand goes back into my policy. So it builds up my policy's cash value. Now I take that 15 grand, lend it to my business again at 15%. So now I have 115 grand lent at 15%. I don't have a calculator, but whatever that would be, if you guys could calculate that, 115 grand times 15%.
Doing it, hang on, times 15% is
17,250. Yeah.
Okay. So now I've got 17,250 as a deduction as a business expense. Builds up my policy, lend it again the next year. So now I've got what, 132,500 at 15%. So you can see how it can just get ridiculous over time.
Yeah.
It just takes time. Nothing worthwhile it happens overnight. It takes time.
Yeah. Okay. Wow. That's really good. I want to get to a few of these questions that are over here in the side chat. And if you guys are on here, if you haven't already, share this so we can get some more people so we can get you guys to ask the questions to Devin while we have him on here live. But Karina had a question a while ago and she said, if you are a low income earner, are you limited on how much you can contribute due to the MEC regs? I've never heard of that. So what is this? And
somebody's done a little homework. So MEC is modified endowment contract.
Okay.
What that means is you can only, remember how I said we were overfunding a death benefit?
Mm-hmm.
You can only overfund it so much until the IRS looks at it and says, that's not a life insurance policy. That's an investment now. So then they're going to start taxing you as such. So basically you want to stay, we try to build the policies like here's the MEC line before it becomes taxable. We want to hover you right below that line without going over. So if it's 10 grand, 15 grand, 20 grand, whatever that is, don't put in more than that per year because then it becomes taxable. So as far as like a low income earner, that doesn't really matter. What you're approved for is based off your income. So basic rule of thumb, you're approved for about 25% of your gross income. If you make 100 grand a year, you'd be approved to put in up to 25 grand a year into a policy. Remember, that's you overfunding it. So the death benefit portion would be a small portion of that 25 grand. You're overfunding to 25 grand. Don't put in more. That would keep you out of the MEC limit.
Okay, so you get close to the MEC limit. Could you just open up another policy?
Bingo. That's all you do.
All right.
So that's why I've got 12 policies. You know, I don't want to be taxed. I hate taxes. It's a necessary evil, obviously, but I don't want to pay more than I have to, right? So as I start putting into these policies and I get to that limit, if I have more money just sitting in my bank account, we've already agreed it's not as good of a place. It doesn't grow as much. It's not as protected. It's in a place that folds all the time because they're insolvent. I'd rather have all that money into a policy with a mutually owned company. It's got more benefits. How can I do that? Just start another policy. It's that easy.
Okay. All right. There's a few other questions. I'm going to rattle them off at you. This seems like a no-brainer, but you have to qualify and get underwritten, right?
Yes.
Okay. Any age limits on these whole life?
Not really. I just had a lady approved and she was 75. It gets very difficult once you're like 70 and older. The main thing they look at is health. Like if you're really healthy, like the 75-year-old lady that got approved, you talk to her, you think she's like 40. She sounds super young, lively. The older you get, you can kind of tell someone's sounding older, and it's because our health really takes a decline. That's all the insurance company looks at is like, they don't want you to die soon, right?
Yeah.
Neither do you. So you're in partnership with a company that wants you to live a really long time. So the older you are, you're more likely to die. So they just look at they're going to take your blood work. They're going to look at different medical records. They're going to look at your driving record. They're going to look at your criminal history. They just want to look at you as a whole and say, is this person going to die soon? And if they think you are, they're not going to insure you. So, but if you're 90, super healthy, you've got a very, very, boring lifestyle. You don't go, swimming with sharks and all kinds of crazy stuff. You'd probably get approved. 75 has been the oldest I've got approved, though.
That makes so much sense because we went skydiving in Florida earlier this year, and Ingryd's like, I can't. I just got my policy. So that makes a lot of sense. Well, that leads into the next question here. I think you sort of answered it, but Adam Catledge asked this. Do you have to go through medical exams to get these policies? So it just goes to your medical records, or do you have to get like, man, I haven't gone to the doctor in a few years. I have to go get a checkup before I can get my insurance policy?
Depends. If you have a minor, like my daughter, I've got 3 policies on her, no medical exams. So generally speaking, minors, you don't have to have them. They just look at medical records. So if your child has a bunch of medical records, then they might have a medical exam. But for the most part, like the younger you are, they tend to kind of push past the medical exam and just look at records. And if they find anything that's kind of like a red flag, they'll have you get blood work, EKG if you need to. Mm-hmm. So not everyone needs one, but most of the time you need one.
Okay. Trisha Holloway asked, how often do you open a new policy?
Me, I try to open at least 2 a year because when you get a policy, like let's say today, what's today, the 27th of September. So if I got a policy today, my medical exam, my application, all that stuff is good for 12 months. So why don't I try to get more policies on that same exam? Because you never know when your health is going to take a turn, right? So like, let's say, God forbid, next year, something happens and my health really takes a turn and I'm no longer insurable. I can't get a policy anymore. So I try to get as many policies within a calendar, or not a calendar year, within a, what would it be? What's the difference between calendar year?
Fiscal
year. Yes.
Okay. Yeah.
So I basically try to get as many as I can. The most I've gotten in 1 year is 4, but I try to get as many as I can.
Okay. Pedro asked, would we get taxed on the money we make on the loan? This is a good question. Everybody should learn this about loans.
Great question. So you don't get taxed on the loan itself because loans aren't taxable. So when you borrow against your policy, it's just a loan. There's no taxes. However, if you take that money and you go make a profit with that money that they lent you, that profit is taxable. The money you took from the policy, that's not taxable. It's growing in the policy tax-free. But if you go make money with it, there's going to be taxation. And that's when you have to get a good CPA to start really lowering your tax bill on that side.
Okay. Okay. Oh, you got that one? Go ahead, Ingryd. I missed yours. When you borrow money from your policy and pay it off every month, does that increase the cash value on the policy? Is that how the money multiplier works?
That is correct. So again, think of it like a house. If you have an equity line in your house and it's say $500,000, if you use all 500,000, you've got no equity you can use, right? If you take that 500 grand and you go invest it and you make, let's say, 100 grand profit. So you've got 600 grand back. You take that 100,000 in profit and pay down your equity line. You got 100 grand in equity now. You can use it again. That's your cash value. You can take that 500 grand and just go make more money with it. It's the same exact thing. Use your cash value to go make more money. The money you make, feed that back to the policy and just keep making more money with the money they let you borrow.
Okay. Did you have something on that on that? Okay. Can you please explain guaranteed returns and what are these companies?
Guaranteed returns mean it is guaranteed. It's never going to be less than 3.25. That's a hard concept for people because for people to wrap their head around it always getting better, it's just a weird concept. Very few things are like that. But think about this. If you're in a plane, right? You're getting on a flight, and it talks about this in the book, Ingrid. So you might remember this in Become Your Own Banker. If you are on a plane and it takes off, it's full of gas, right? There's all kinds of gas to get to that destination. So it's heavier. So the plane has to work harder to fly than it does when it lands because there's less gas. It weighs less. So the plane is guaranteed to get more efficient the more it flies, right? It's the same kind of thing. Your money is guaranteed to get more efficient. It's guaranteed to keep growing. The reason why they can guarantee this is think about an insurance company. What does an insurance company do? They assess risk. That's all they do. So they are very, very, very good at assessing if an investment is risky or not. They do not invest in risky investments. They know without a doubt they can make at least 3.25 all day, guaranteed. They know they can. These companies consistently make 5, 6, 7%. Steady Eddie. They don't go try to hit it to the moon with crypto and make 40% because that is risky. They make very sound, calculated investments. And when they're profitable, they guaranteed you 3.25. When they're profitable, you get a dividend. So they give you more growth the more profitable they are. So that's the first thing. The second thing, who are these companies? Mutually owned companies. That means when you put money in there, you're a part owner of the business. Therefore, when they are profitable, you get a dividend. Companies we use are One America, Lafayette Life, Guardian, Security Mutual, Penn Mutual. We use these companies because they've been around forever and they're A-rated and they've paid dividends every single year for over 100 years.
Okay, I want to go to a question I saw here. Ilya asked, how hard is it to manage 12 policies? So if I go through you, are you going to help me manage it, or am I managing it on my own and I have to figure this out?
Oh, well, one, you're not going to start with 12 policies.
Okay.
Starting with one policy, it's very easy to manage. It's not a difficult concept. It's just so much a different way of thinking. Really, all you're doing is you're making an arbitrage on money. You're borrowing at 5%, let's say, from an ever-growing pot of money. You borrow at 5. If you can go make more than 5, that's all you're doing. So if you go make 10, you just made a 5% arbitrage, a 5% spread.
Mm-hmm.
That's all infinite banking is. The better you can get at making that spread, that arbitrage, the more you're feeding back to your policy. And that money never stops growing. That's the concept. It's very simple. What makes it difficult is there's so many ways to do it. It's infinite. Like what Ingryd said, couldn't I just borrow from it and then start another policy? Yeah, you could do that. So that's what makes it confusing is there's so many different ways to do it. But at its core, it's just making a spread on money.
I'm sorry.
No, go ahead.
Oh, I was just going to say something that really stuck to me when I was learning about this that I think is really prudent is that you have to respect that this is borrowed money, even though it's not, the source of the borrowing isn't necessarily your credit card or your like loan from somebody else. It technically is from you. And so if you're going to use this strategy, you should respect yourself enough to pay yourself interest. So I don't know if you want to touch on that because I do appreciate that you can start doing this. And if you're not paying yourself an interest on the money you're borrowing, just like you did in the example to lend yourself marketing dollars and you're going to pay yourself an interest rate. If you're not doing that, then you're going to grow much slower. Mm-hmm. And you're not going to actually leverage the multiplication that can actually happen by paying yourself back with interest.
Yes. So I'll touch on that and then also let you guys know how I manage 12 policies. So think of it this way. If I have money in my pocket, it's my money, right? It'll eventually be someone else's. I'm going to pay for something and now it's their money, right? If I go buy this water, I have to give the money to get the water. So it's no longer my money anymore. I'm just in possession of the money right now, right? If it's my money right now, shouldn't I value it more than any other money, right? If you borrow from a bank to get a car loan and you always pay them on time every single month without fail, because you don't want your credit to go bad, right? You don't want them to take the car. You're always paying them with interest. That's how it works. They're not giving you 0% interest. And if they do, they just mark the price of the car up. So they're making it somewhere.
Mm-hmm.
You pay them interest every month without fail, but you don't pay yourself. You're saying that their money is more valuable than your money. That makes no sense. Your money should be the most valuable money you have. So if you borrow against your money, which is what you're doing, pay yourself back with interest. The more you pay yourself, the bigger the policy gets. Bigger it gets, more you can use it for bigger things. I've bought 4 cars. I've bought a wine cellar in our house. I've done landscaping in our backyard. I've bought my daughter's braces. I do every single real estate investment from policies. I've bought this watch. I bought a Rolex. Gosh, the list goes on. Everything I buy now is from policies, and I'm paying myself back with interest. Everything. Only way that's possible is I keep feeding more money to it.
Ooh, what a great question. Thank you for asking that one, Ingryd. All right, there's another one. Okay, this is a good one because I'm a vet as well. So Adam Catledge said, do they take VA disability ratings into account? Let's say someone is 100% VA disabled at 38. Is that going to affect your whole life policy?
Well, Caroline, first and foremost, thank you for your service. Appreciate you.
Thank you for your support. You're worth it.
Adam, if you're a vet as well, thank you for your service. So VA disability is a tough one because a lot of times, a lot of medical records come into account with that. So they do a lot of digging. Most likely it's going to affect you getting approved. If you're approved, what'll happen is your death benefit will probably be a lot lower than someone who doesn't have any disability. So, but it's not about the death benefit. It's about the cash value.
Yeah.
So your death benefit is kind of just the cherry on top. Your cash value is what counts. So if, let's say my death benefit on a policy is $2 million for putting in 50 grand a year, I'm just throwing numbers out. I don't know exactly what to do, but let's say that's what it is. And then the same person, same age, puts in the same amount of money and their death benefit is $1 million. If the cash value is the same, who cares, right? It's about the cash. It's not about the death benefit.
It's a good lesson. Go ahead, finish.
If you're approved, death benefit will probably just be lower. If you're not approved, which is honestly probably highly likely that you wouldn't be approved, beautiful thing is you can still get policies on other people. I've got 3 policies on my daughter. I've got 3 on my wife. I've got 1 on my mom, my dad. You can insure business partners. You can insure siblings. You basically can insure anybody you have a vested interest in. So the insurance company looks at it and says, does Devin Burr want his daughter to live a long time? Yes. Of course they'll insure her. They just won't let you insure anyone that you have no interest in because let's say I insured Joe Schmo off the street. Who's to say I don't just hire someone to do a hit on him so I can get the death benefit? I don't care if he lives, right? That's the way they look at it. So if you're not approved, just insure a child, a spouse, a parent, a sibling, a business partner.
Okay. Well, it's just a good lesson because my hearing's messed up from being in. I don't have a whole lot of other things, like just a little stuff, but I haven't gotten my disability yet. And I was like, that's active income. I'm like, ooh, okay, maybe I should wait. I'm fine without it, but that's just a good little lesson. Okay. Trisha asked this question. This might be a good one. Did we already cover this? Can you also explain what paid up additional is?
Oh, that's a really good question. So the paid up additions is you just overfunding the policy. So remember I talked about you have your death benefit, we lower it. That's your base premium, BASE, base premium. And then you overfunding it is paid up additions. It's basically just paying for more insurance that doesn't have any cost. So that's what gets you all the cash value. But remember, you can only do the paid up additions so much until it becomes taxable. So we know how to structure it to where it doesn't do that. And then just don't put in more than what the contract says. It'll never be taxed.
Does your MEC get reassessed every year too, or how does that work?
Yep. So the MEC line always changes. So what I tell my clients to do, same thing I do every year with every single policy, when the anniversary date comes, I call the company about a month early and I ask them, I've got premiums due. How much can I overfund this year without it becoming a MEC? So they'll basically run the calculation and they'll let me know you can put in X amount of dollars into paid up additions. I do that because I know that compound interest takes time. The longer you give it, the bigger it gets. So I want to put as much into these policies as early in my life as possible so that later on in my life, the growth is just stupid. So I don't have to work. I can just grow off. I can just live off the growth.
That's a good question. I think this leads into a perfect one that Sean had. Is the base face amount given to the beneficiaries along with the death benefit at the time of the policyholder's death?
So he's thinking of it as two separate things. The base face amount is what that base amount pays for in death benefit. So that is paid out, plus the paid up additions gets more of a death benefit. So whatever they're putting in, there's base premium gets you a death benefit, paid up additions gets you more of a death benefit. Whatever that total is, when the person passes away, beneficiary gets the total amount minus any loans that weren't paid back. Okay. So if you pay all your loans back that you're using the policy for, family gets the full death benefit tax-free.
Okay. Good one here. Greg Perez, because we've actually had somebody come on. Ingrid brought in, what's EQRP's name? Brought him in to talk about
Joel
that.
Landon.
There we go, Joel. Is it worth pulling out of an employer 401k towards your policy to get a whole life insurance policy?
Oh, I love this. I actually did this. I could talk about this stuff for hours. Obviously.
I know. Do you have time? We have 2 minutes left, and I am only a quarter of the way through the end of the questions.
By the way, thank you all who have been engaging in the comments. I don't think we've had one guest who had this many questions. Yeah. So this is amazing. And I love that you all are. So make sure that you're liking it, you're sharing this, because this is great. This is how we build wealth, guys. This information isn't shared in high school. It's not shared in college. Why? Because it's easier to keep us as employees and not actually helping us build our future. So make sure you're sharing this out to anybody you think that might benefit from it.
Yeah. And then if you're not, I'm going to just show you guys how to do this one more time. This is his Instagram. You click on the blue button and then you're on there. Click on the blue button. That's how you can find him. And then click on the Money School REI to get, just for everybody who showed up late, the little lessons on infinite banking. I didn't show you guys the whole steps here. I got to share this tab. So it'll bring you to this page. Click on this button here, and then it'll bring you to this page. I just want to remind you guys. But yeah, please share this with everybody so we can all get out of the rat race and enjoy our lives. So Devin, really appreciate you going into these questions. Let's get back over to the one that Greg asked, which was
yeah, if we can go longer, I've got time, guys. So
okay, well, we'll soak up the time we have. I want to be mindful of Ingrid because she's on vacation with her family. So if we need to be Ingrid, I'll close this out. But to this question, is it worth pulling out of our 401k to get a policy with you?
1,000,000%. I did this on my second policy I ever did. I had about 175 grand with an employer, and it was just sitting there, not doing anything because I had left. If you guys remember Quicken Loans, I left. So I had this 401k just chilling. I'm thinking, well, if I just leave it, I don't know what's going to happen. Like the 401k can go up and go down and go sideways. I've got no control over a 401k. If I take it out, I'm going to get paid. I'm going to get hit with a penalty. I got to pay the taxes. But then I have control of the money. So I took the money out. I was hit with taxes, penalty. I was left with like 125. So now I had control of $125,000. I took it, put it into my second policy. So 125 now, guaranteed to grow for the rest of my life. It becomes a lot over time. Instantly, within a week or two, I had access to about 109. So I took that 109. Again, I've got control of it. I borrowed against it. I won't get into all the steps because it's a lot, but again, I lent it to my business, blah, blah, blah. I took that 109 and I went and did a flip. I made about a $60,000 profit. It took about 4 months. The 109 into the property, I got back about 170. So think about that. I lost 50 grand by taking the 401k. I made it back in 4 months by simply having control of the money. And now that 125, instead of it going like this with the market, it's guaranteed to grow. I'll never pay taxes on it. With 401ks, you pay taxes, you're just kicking the can. You'll eventually pay taxes on the money. When you pay taxes at 60 years old, are the taxes going to be higher or lower? Probably higher.
Oh, really? Okay.
I mean, think about it. Taxes don't go down. If they go down, they just tax us on more stuff. Right?
Maybe I'm getting confused because doesn't like Harbaugh from Michigan, doesn't he get paid through life insurance? Is he doing it, pushing it off so he gets a lower tax? Maybe he'll have a different job. What is that? Maybe I'm confused on those two.
He's utilizing infinite banking. He's got these insurance policies and he's just taking loans as income. Loans aren't taxed. And the money just keeps growing so he can keep taking more loans.
Yeah. And NCAA, the NFL, that's how they pay their coaches now because it's to their benefit to just take loans against their policy. I will want to say something very clear, though. What Devin did was not a rollover. He just cashed out his 401k. As you guys know, we've had, or maybe some of you know, we had Joel Landon on the podcast. Definitely, if you didn't get to watch that, go see the podcast we did with him. He's part of EQRP, which is a 401k trust company. So in my scenario, I have a 401k as well, but instead of taking it out like Devin did, I rolled it over into a new thing, which was a 401k trust, kind of like a solo 401k. And now I have complete control of it as well, and I could invest it. So the most you can loan against a 401k loan, which is different. Yeah. 50%. It's 50% or 50,000, but 50,000 is the max. So let's say 50% was 100K. The most you can still loan to yourself is 50K. Yeah. I would say there is no right or wrong. You've got to figure out what makes sense. But I love how Devin took control of his money. He knew he had enough skill set in a specific realm where he was going to make that money back. And if you know that enough about yourself, or you are ready to be a private money lender and you want to lend Caroline and I some cash, we're happy to help you grow that money and create a partnership to in that regard. But there are different ways there's just so many strategies. Like the reality is there's so many ways for you to protect your money and to make more money. You just have to go and pick up a book or check out YouTube and do some research, because there's just so many ways to do it.
So true.
If you do have an employer 401k and you can't do a whole lot, I do recommend either lending to yourself up to that 50K to start your policy. Or if you've moved jobs and you have a 401k that's just sitting there, I check out EQRP. Or if you think you have enough skill set to multiply it quicker, I would recommend what Devin did to himself, right? So, right. Or you could I'm not a CPA either.
You can do self-directed IRAs. There's like so many things you can do. In my opinion, the best thing you can do is a policy, because you have total control.
Yeah.
In a self-directed IRA, let's call it, it's growing tax deferred. You never pay any taxes until you start taking that money out, and you take out more than your cost basis, meaning you take out more than how much you've put in.
Yeah.
So if you've put in 500 grand, once you take out 500 grand and $1 is taxable. Okay.
Yeah.
So here's the thing though. If you have that money that you make, like if I've got 500 grand in a self-directed and I take it and I go invest it into a property, I can do that. And all the gains are tax deferred. However, all of those gains have to go back to the IRA. You can't use them. In a policy, if I take a policy and I put the money there, it's guaranteed to grow. I borrow against it. I go do an investment. I make double my money. I don't have to put it back in the policy. I can go use it for whatever I want.
Yeah. That's a good point. And only you can answer that, right? Because like for me, I have a diverse point of view where it's like, I want to grow retirement money and then I want to grow active money. And so that's how I've diversified my portfolio. So like the money I have with my 401k or the money I have with my policy with you, Devin, I use that to lend money out so that it's more passive. Like, hey, here's some returns that we're getting back. I don't have to necessarily actively work for that money. It's just money that comes into, it comes to me regularly. The active stuff, so the stuff I'm doing with Caroline and the stuff that I'm doing like to make money, like wholesaling or flipping, that's active. So that's how I've diversified my portfolio. This money is like sleeping money.
Do you use the policy to lend is what you're saying?
I use the policy to lend. Yes.
This is going to blow your guys' mind. When I realized this, I was like, this is freaking insane. This is why I started putting every single dollar I have into policies. So what's an average rate of return that you're making on lending?
Between 12 and 15%.
Okay. So let's just say 12% on the low end. If you have $100,000 and you lend at 12%, you're making $12,000, right? You made 12%. Pretty simple. If you simply put that 100 grand in a policy first, this is where it gets crazy. That money is guaranteed to grow plus dividends. So let's say that's 5%. That's around what it usually does, 5 to 6. So if it's making 5% in the policy and then you borrow against it, you borrow $100,000. Now you control $100,000. That's just your future death benefit. Remember, your 100 grand is sitting here compounding. You've got $100,000 at 5% and you lend it at 12, right? How much are you making? If anyone can get this right, I will be blown away.
Is it 17,000? No, it's not 17,000 for you.
So you're making 5% in the policy.
Yeah, would that be 5% on the policy? And then you said 12%, so 12,000. I'm sorry, I was getting 17. I'm doing 5 plus 12.
So just look at the percentages. You're making 5 and you're making 12. So you're making how much?
It's over 100% because you got to take out the 100K out.
Here's what it is.
Oh.
You're making 5% of the policy. You're making 12% outside of the policy. So you're making 17. How much money do you have in the deal? Your 100 grand is sitting in the policy. You're borrowing 100 grand. So you're paying 5% to borrow that money. So you're turning 5% into 17%. So that is that's a 12% net, which would be over a 200% return by simply changing one thing. You went from 12% to over 200 by simply putting the money in the policy first. Crazy. That's all you're doing. You're turning 5% into a bigger number. So you're turning 5 into 17. That is actually, now I want to know what it is.
Because Caroline, when you're putting into a policy, you get to withdraw that money back.
Yeah,
it's not like jailed. You get to duplicate it almost.
Are you seeing the gears moving in my head? I'm like,
yeah. So the number is exponential. It's not linear.
Go ahead, Devin.
240% return by simply putting it in the policy first. Now your money's not being used. Your money is sitting in a savings account.
Yep.
Right? It's just sitting there growing. You're borrowing against it to get 100 grand at 5% interest. You're turning that 5% interest into 17% total. That's a 240% return. Crazy. When I learned that, I need to put every last penny I have in these things. And that's why it's gotten so big and why I have 12 policies.
All right. Wow. Okay. I want to try and get to a few more. I've seen this one a few times. There's a misspelling in here, but Rastelli said, how can an S Corp, and it's supposed to be business, fund a personal policy? How is that written off in the business? Do you have to pay yourself from the S Corp into your personal banking account to be able to pay for the policy? As a non-CPA would say?
Not a CPA would say. You'd have to find a different loophole. Like I talked about the one earlier where you can pay your kid and then that money can go into the policy. But for the most part, you can just fund the policy from any bank account. Doesn't matter where it's funded from. It could be from a business, LLC's bank account, S Corp, PLLC. It doesn't matter. The money can go into the policy. It's not a write-off, though. unless you find that loophole where your business pays your kid then funds the policy, or you fund the policy for them. So there's just not a lot of ways to do that when you're funding the policy. When you're paying the policy back, there's a lot of ways to like lower your tax bill.
Okay. Another question I'm not familiar with is Mark Avaloff said, what if you have a 457B? What's the best route to use that?
457B. That is, I think it's like teachers and different government workers, if I'm not mistaken. It's like their retirement account.
Let's look it up.
Correct me if I'm wrong. I think that's what it is. And if that's the case, like, I don't know the ins and outs of that and how that would work. So I wouldn't be the best person to answer the question, I guess.
It's Google AI says a 457B plan is a tax-deferred retirement savings plan that allows employees to contribute pre-tax deductions from each paycheck. The plan is available statewide and local government employees, as well as employees of certain nonprofit organizations. It works like a 401k. Employees can divert a portion of their pay to their retirement account.
Cool. So I was right. I mean, if it works like a 401k, there's a couple things you can do. You can loan against it, or you can take a loan out, 50 grand or 50%, whichever one is higher, or whichever one is lower, sorry. And then use that, or you could just, close it out if you're no longer employed there. That's what I did. Or then you can do a rollover like Ingryd did. There's a lot of different options, but I think any government sponsored plan, and this is just me, I think government sponsored plans, they're put in place to cover up a mistake that the government had. So they're putting a Band-Aid on a cut that they caused, right? So I don't believe in them. I don't think they're good. You don't have much control. Some of them you do, just most of them you don't have much control at all.
Okay. Adam Catledge had a question. Is there a limit on how many loans you can take from a policy, or is there a limit on how many loans from a policy you can take? No limit?
If you have cash value, you can take a loan. Doesn't matter. If you've got it, you can take it. Just like an equity line. If you have money on the equity line available, you can take a loan against it.
Okay. I think yes, Sweet Home for You said I've shared this 3 times already. I think we've gotten just about every single question answered here so far. Okay. Well, here's one. We kind of already answered this, but is there a minimum to open up an account like this?
Yes and no. You could start a policy for $10 a month. It's just going to be anemic. You're not going to be able to do anything really with it. Like if you put in $10, you might have access to like 7. You can't do much with $7, right? So for it to really make sense, bare minimum, you want to put in your age times 10 per month. I'm 38. I'd want to put in at least $380 a month. Even then, it's going to take a while to really have enough to do something with. From my clients, what I've found is like the sweet spot to be able to use the policy right away is 10 grand a year. You put in 10 grand, you got access to 7, give or take. So you can do some stuff with 7 grand. You can't do much with like 700, So there's no real limit, but it's going to take a long time, the lower amount of money you put in it.
Yeah. And by the way, this is why you need a good network. Somebody just said like, hey, could I use a 0 interest business line and pay for my policy? Yes. Could you ask your mama for some money and you're going to pay it back? Yes. Like it doesn't matter where this money comes from, so long as you can fund it and obviously be a respectful person and pay that loan back. But really from beginning to end, I would say you're going to have to go through the medical stuff. You're going to have to underwrite all that good stuff. I would say from beginning to end, you're probably going to have your money back within 45 to 60 days conservatively. It could probably be much, much faster, but it just depends on, if you're a sprite young gal or if you're, a little bit older, there's a process here, but I would say that's a good gauge.
Yeah. Just to clear up though, it doesn't take that long to get the money. That's how long it takes to get approved.
A process. Yeah.
Right. Once you're approved, it's really quick to get the funds. Mm-hmm. One thing I just want to touch on that it was an eye-opener for me is these policies are built in such a way that generally speaking, by like the 3rd year, You put money in, you can take out or borrow against more than you just put in. So if you put in 10 grand, you're borrowing more than 10 grand, which is crazy. And then it always goes up. So I've got a policy that I put in 150 a year. At year 10, I've looked at this. I put in 150. I can take out almost 250. So think about that. If I don't even have 150, let's say all my money's out working, I don't have 150. I would literally hit up Ingrid and say, Ingrid, do you have 150 grand I can borrow for a week? I'll pay you back 155. Would you do that deal with me?
100%.
Right. We would put a contract in place, but why wouldn't you do that? You'd make $5,000 in a week.
Yeah.
Why wouldn't I do that? I'm using your 150 to compound for me. I instantly have access to 250. So I'll gladly pay you back 155 because I still have access to 95 racks. You know?
Mm-hmm.
They just get silly over time. Compound interest takes time, but the longer you give it, the numbers just get silly.
Yeah.
Insane. It goes into the what's the thing where you could take like $1 million today, the compound effect book, and it's like, or you could just double a penny for 30 days. You're gonna have like $15 million at the end of the 30 days with the penny.
5.3 million or something like that.
There you go.
But the crazy thing is, if you look at that, it doesn't pass the million until day 28.
Mm-hmm.
It takes time, but most people would think, oh, and then if you interrupt that compounding, so if you take the money away, which is what most people do, they put their money into something that's compounding and then they use it and they interrupt the compound growth. So it never gets to that compound growth. It's just, it doesn't go linear. It's exponential the longer you have it. In that example, you double a penny every day for 30 days. At day 28, it's still less than $1 million. 2 more days, it's over, I think it's 5.4 or 5.3 million. Compound interest just takes time. The longer you give it, bigger it gets. Infinite banking, you never interrupt the compound growth. So your money just keeps getting bigger.
I want to wrap this up, but then everybody keeps asking more questions in the side chat here. I keep trying. I think Sydney came in a little bit late, but could you explain one more time why a whole life policy?
Oh, I just told her to go watch the replay.
Okay, perfect. Well, never mind. You got the message in the side chat.
But I do want to hit one. So Daryl's question, and I think I know the answer, but like, why would somebody choose infinite banking over velocity banking? And I feel like I know this answer, but what's your?
I want to hear what your answer is.
Well, only one has a guarantee. The other one is how good are you with your money? So, velocity banking, as I understand it, is you go and you get a good credit line or a HELOC, and you're using a very similar concept to pay down debts. But only infinite banking has a guaranteed interest rate that you're going to make money. So it multiplies your money. Both are really excellent concepts, especially if you're somebody who has a lot of debt that needs to pay down. But infinite banking is going to give you more money.
I'm a proud mentor right now. I'm so proud. Yeah, that's basically the difference is like velocity banking, you're using an equity line or whatever to basically, like, let's say you take money out and you pay off all these debts. The premise is you're paying off debts that have a bigger payment than what the equity line's payment is on the same amount of money. So you're able to pay those things off, or you're able to pay the equity line off quicker by just paying the exact same payments you had on those debts back to the equity line. So that's the whole premise. It has nothing to do with the money growing. With infinite banking, you're putting your money into a place that is just going to keep growing. So the amount of money you can borrow always goes up. It never goes down. It only goes up, guaranteed.
All right, I'm going to bring Roshana's question up. I know we've touched this, but does the guaranteed return ever change, or are you locked in when you get your policy, like when you lock in at an interest rate for life?
The guaranteed interest rate never changes. It'll always be by the contract. You're guaranteed to make at least that on your money.
There we go.
So you'll never make less, but it's not guaranteed, but you'll always make more because the company has a profit. When they have profits, they share those profits in the form of a dividend. So that brings the 3.25 up. It's just not guaranteed they'll have a dividend, but they've paid a dividend every single year for over 100 years. So the highest the dividend's ever been is like in the 80s. It was like 15%.
Ooh.
Interest rates are crazy high. So dividends this year, I'm actually really excited to see what they end up being on the dividend scales, because the insurance companies, they pay based off profitability on dividends. All this money that you put into a policy, my money, Ingryd's money, your neighbor's money, everyone that's paying their premiums, it goes into this big, huge pot of money. They're general funds, billions and billions and billions of dollars. They anticipate they'll have to pay out X amount in death claims, death benefits. So they don't touch this money. They earmark it. The rest of the money, they go invest, right? If interest rates are higher, what can they do? They can lend the money at higher interest to banks, to different institutions. If you look on any insurance company's like asset sheet, you'll see they lend blocks of money to banks. And what do banks do? They lend it back to us. So why would you just not go to where the bank is getting the money, which is the general fund? How do you do that? You put money in the general fund. So basically my point is, as interest rates go up and the insurance company can lend at higher amounts, they can be more profitable. So therefore the dividend scales should go up. And I would love to see them probably around 4 or 5% this upcoming year. So that means the total growth would be around 7 or 8%. That'd be awesome. And that's tax free.
This has been super duper. You're gonna have to come back.
Twist my arm. All right.
Maybe by then I'll have my license, so that we just send more people that way. No, I've been considering it because I feel like this is a passion of mine in terms of like how can we help people grow their money. It just seems fun. So
I've again, guys, I could talk about this forever. And the reason being is I'm very passionate about it. I love helping people do what I did. Not too long ago, I started my first policy in May of 2020. So I'm not like 20 years into this. I'm kind of a newbie, but I've engulfed myself in it. And I would consider myself 100% an expert at this point. And I've helped a lot of people. And I get text messages a lot of clients being like, thank you so much. This is changing my life. That gives me like emotional income, which actually I value way more than the actual income. Income's great. I've set up a ton of policies, so I've made a lot of money. But when someone tells you like you're changing their life, it makes you feel so freaking good. You just want to keep helping more people.
I love that. Well, Devin, thank you for running over on this. Everybody appreciates that, guys. If you guys would, and I'm going to share his Instagram one more time, go thank him for coming on here. Tag him, take a picture of this and tag him. This is his Instagram again, Mr._Burr with 4 R's. Give him a little love on there. Devin, seriously, thank you. And if you guys want to, right here, I'm highlighting it there at the bottom, moneyschoolrei.com/Devin with maybe your phone number, combination, whatever. Connect with them on there. We definitely, if I would like to have you come back, I'm going to reach out to you so I can get all of my stuff set up. Thank you. If you could, the one question I like to end these podcasts with before we ask everybody to, share this so more people can see this and we can be self-sufficient and we don't need to rely on these government policies or Social Security in our old age. If you could go back in time, anytime in your life, you have 2 minutes to talk to yourself. When would you go back and what would you say to yourself?
Ooh, such a good question. That is good. Oh, I would go back to junior year of high school. What are you, like 17 then? 17, 18. So anyone who knows me, I'm just like this fun-loving guy. I wear my heart on my sleeve. I don't take myself too seriously. I joke around a ton. I'm a big goofball. Up until that point in my life, and then in high school, I think you're always trying to find yourself. So I started to act different and try to be like other people and fit in more. So I started like becoming like a little thug, and like I was getting jumped. I'd get into fights. I got shot at one point. A bullet hole went through my headrest. So if I would have been sitting in the car for like a minute longer, I would have died in 2003. So all of that happened because I was like, I wasn't being true to who I am, and I was trying to be something else. And I think when you do that, when you're not living authentically, people can sense it, and it just rubbed people the wrong way. So I ended up getting shot at. I ended up getting jumped, all this stuff. So I'd go back at that point. I would talk to myself and I would say, dude, what you need to do is start getting around really, really high quality people, super high quality people in all areas. People that are a great family man. Get around someone who's really wealthy. Get around someone who's really athletic. Get around someone who's super healthy and works on their diet, because life is meant to be abundant in all areas. Wealth, healthy, being fit. If you don't have your health, you can't go do things with money, right? So I would tell myself, get around some people that are just up here, because I am a firm believer that you are a product of your environment. If you're hanging around with knuckleheads, which is what I was doing, I was a knucklehead. I started being someone I really wasn't. If I hang around people that are really successful, which is what I started doing in real estate, I started going to meetups and just trying to get around people like Pace Morby. Me and Pace are homies now. Love Pace. All these like big players, you start emulating them and you start doing things they would do. Inevitably, you're going to start being like they are, and you're going to have the same kind of lifestyle. So I would have told myself that at 17. And if I would have done that, I'd probably be this interview would be on a yacht right now. I'd have a yacht. You'd see like a little helipad back here where my helicopter is. You know what I mean? Like, it would be just ridiculous. So I wish I could go back. I would definitely tell myself, get around some freaking all-stars.
Well, Devin, thank you so much for answering that too, and for your time today. I can't wait to connect with you guys. Make sure you're on his Instagram again. Thank you so much. Please like this, share this. We want more people to see this. If you think this can add any value, we'll do this again every Wednesday at 4:00 Arizona time. We go live. Ingrid, you have something you want to say before we close out?
I was going to say, go follow Devin on his YouTube, because the reason I was so attracted to getting around Devin is because he's an excellent teacher. I saw some of you say like, oh man, I need a whiteboard. I need some sort of something. He's so good at teaching you how this works. And if you follow his Instagram, his reels are super entertaining and easy to understand. So Devin is a great teacher. He does bring out the whiteboard, and he will teach you how this works in a much better way than we can in this just 1 hour quick teach me podcast. So highly recommend his YouTube, highly recommend his Instagram. I'm really so happy that Devin is part of my circle of network of friends, because he really is genuinely somebody who wants to see other people win. So thank you so much, Devin. Thank you for coming on here and teaching the folks that we love to podcast with, and letting them know really how they can become more wealthier.
Thank you guys for having me. So nothing but love for both of you. I appreciate you guys, and appreciate everyone that stuck around, all the questions. But yeah, reach out to me on social. I answer all my DMs. It's actually me, so sometimes it takes a little longer, but I answer everybody. So reach out to me. Watch that training video on my in the bio, and once you watch that, you'll have the ability to schedule a call. Most likely it's not going to be with me. I take overflow calls if the team is just swamped, but I've got 5 agents. So you'll most likely speak with one of them. Very knowledgeable, all of them on the concept, but we just love to help.
Thank you. I'm going to check it out right after this. Thank you so much, guys. We'll see you next Wednesday.
Thank you, guys.
Yeah.